Good morning. All right, we're nearing the middle of August. Megan's got a whole plethora of real estate data to share. I know this last week wasn't as exciting newsworthy as the previous week. You guys, I dumped on you the amount of economic data last week, but this week we had this crazy change of interest rates, literally a half a point, sometimes daily. So I'm going to talk about that, what's happening, what happened with the inflation numbers on the second half. Megan's going to jump into what's happening in real estate. But, obviously the conversations around higher inventory, lower new listings. We're still seeing double-digit appreciation and double-digit average and median price growth. I mean, this is going to start slowing down. Kids are going back to school. I was listening to a podcast this morning. Kids in Texas are going back to school on Monday. So here we are at school season, and real estate is going to shift a little bit even more. So here's our quotes for the day. I have two. The second one is super short, but I'm really hyper focused on this conversation around people thinking that the housing market is going to go into a recession, that the housing market itself is going to bust. I'm doing a lot of TikToks lately. Yes, it took me a lot of time to get there, but I finally got there. And there's a lot of haters in this world saying that real estate is about to lose its shirt, and that lenders and real estate agents are the ones that are pushing America into crisis. And I would disagree on all fronts. And I go into arguments on this on a weekly basis. But here's my quotes because they resonated with me, given the fact that we're up against, I don't want to call it an enemy, but we're up against some false assumptions. Real estate, here's from Russell Sage, right? So he was alive from 1816 to 1906, and he was a very wealthy railroad executive. So here's his quote: "Real estate is an imperishable asset, ever increasing in value. It is the most solid security that human ingenuity has devised. It is the basis of all security and about the only indestructible security." Here was a very wealthy man looking at this going, real estate always goes up. Yes, during the biggest housing crash ever in history, we lost 25%. But other than that, you just can't measure the losses. My second quote is mine. "Real estate isn't about money. It's about options. When owning real estate, you have options, especially after the last 2 years." So Megan, with that, what options do we have?
Oh my gosh. Well, the shift continues to happen here in Metro Denver, and I wanted to go over what happened last month very briefly before we get into the weekly numbers. We actually saw a pop of activity that happened over this last weekend where a month's supply of inventory came down and our active inventory came down. But we need to talk about what happened for the month of July before we get too far into what happened just this last week. And so we'll go over some of those numbers, and I want to share with you some of those hot spots in Denver so that you guys can see what I'm looking and it won't let me share my screen slideshow.
Oh no.
There we go. Awesome. So this is for detached single family. We'll breeze over this one real quick. Next week, we'll talk a little bit more about attached single family. But overall, for the month of July, our detached single family active count came up to 5,005 total available units for sale at the end of the month. That is up 24.4% from where we were 1 year ago and 126.6% higher than where we were 1 year ago. Now, our active inventory is going up, not because we have a lot of new listings. New listings actually fell by about 20%, but it's because we have fewer units going under contract, so our properties are aging in place at this point. So our active inventory has the ability to continue to bolster. Pending transaction count fell by about 11.1%, and we put about 3,000 units under contract last month. Active inventory has the tendency to rise as we go through the later part of the summer months and as kids head back to school. Usually in the month of September is where we have the highest amount of inventory that's available, with about 5,600 units available for sale. So I expect there to be an increase in inventory as we go into the next 2 months when I come out and report those monthly numbers. And then usually what happens in September after Labor Day weekend, a lot of sellers end up pulling their properties from the market, either withdrawing or expiring those listings in favor of waiting to list until next spring when the market really picks back up again. Now, I've had a lot of questions about, should I list now or should I wait until October, November, and December when the market stabilizes? And the truth of the matter is that you still have more units that go under contract, which this is what this shows with our pending transaction count going through month over month. But we end up seeing that our pending transaction count really starts to die off as we get into October through December pretty significantly. So my advice to you is get that property to market as soon as you can. Looking at month supply of inventory for all price ranges, we're now above 1 month worth of inventory for all price ranges that I can measure. That means that we have more homes in the market than buyers to sell, than buyers to purchase those properties right now. So the likelihood of you going under contract with multiple offers has started to fall off the table. Now, again, it's not falling off the table too drastically. We still have about 34% that are selling for over asking price, but that's a stark comparison to the 70% over that we're going for over asking price back in January through April earlier this year. We're looking at still some very good numbers for even the multi-million-dollar segment, where we're looking at 4.5 to 7.8 months worth of inventory. What I would liken this to is we're back to 2019 again, where the market is still very good, but it's not the insanity that we've had for the last 2 years in a row. So back in 2019, interest rates rose from about 3.5 to 4.5 for the first 6 months of the year. For 2019, we're back to that spot again, where the market is adjusting to the new levels of interest rates. Hotspots in Metro Denver, if we look at the map, this is month supply of inventory benchmarked against 1.58 months worth of inventory. Areas that turn red are going to feel more competitive, and you're more likely to be in multiple offer situations, versus those that turn blue or green. They're going to feel less hot, and you're going to have more negotiating power as you get into some of those territories. But there's this inner landlocked ring suburbs that run right around the inside edge of C470, where we're seeing the least amount of inventory right now. There's this continued hotspot, this corridor along the eastern edge of Denver and the western edge of Aurora, down here in the Highlands Ranch and Littleton and Lone Tree, getting into some of those southwest foothills communities. We're looking at some hotspots too, where we have about 1 to 1.5 months worth of inventory. Out here in Lakewood, we have 1 month of inventory, and Applewood continues to be a nice little hotspot as well. Up here in North Denver, we've got a little hotspot there too, right below Rhino, where we're less than 1 month of inventory. Areas that have cooled off substantially, we're looking at Sterling Ranch down here near Chatfield. We've got resale units coming to market that are competing with new construction, and oftentimes consumers are choosing to purchase new construction at a similar price point as to the resale market, rather than buying a home that's been lived in. And so that number has jumped up to 2.74 months worth of inventory. We've also noted cooling down here in the Castle Rock and Larkspur area, where we're now up over 2 months worth of inventory. So for every one buyer in the market, they have more than 2 choices available for them. Elbert County and Parker ended up cooling off pretty substantially. We're now down to up to 3.17 months worth of inventory. And just south of the airport, we're looking at about 3.26 months worth of inventory in this Green Valley Ranch area. Lodo continues to be a cool spot. We're looking at about 3.1 months worth of inventory in Lodo, so that market has really cooled off. The odds of selling as we got into July ended up dropping down by about 10% going from June to July. We're now sitting at about a 51.5% odds of selling. And again, that takes us right back to where we were pre-pandemic for the month of July, where we're seeing those odds of selling come down. Usually for the month of July, we're sitting at about a 57% odds of selling. It dropped down to 51.5% odds of selling. At that number should start to stabilize as we get into the later part of the year, where we have about a 56% odds of selling any given month from October through December. Looking at showing data, showings ended up dropping off by about 11.5%. We saw 53,000 total detached single family showings that happened during that month, which means that you should have had about 6 shows per listing. Shows to pending continues to be a really important metric for you guys to look at. We're looking at between 11 and 12 shows to go under contract. So again, slow down the rate at which you're making price reductions. Make sure you get enough people through that house and enough feedback on that property before you go through and make a price reduction. Unlike what we saw earlier this year, where if you weren't under contract in the first weekend, we knew that you had a pricing problem, versus now it's taking 2 or 3 or even 4 weeks to go under contract. So slow down the rate at which you're making those price reductions. We still saw that 53% of all the properties were under contract in 7 days or less. So it's still more than half, but that's down by 14.5% from where we were just in June. Average days on market is up to 13. So again, it's taking about 2 weeks for properties to go under contract at this point. And average days on market has the tendency to stretch out as we get into August through December. We're still well below the average for what we've seen going back to 2013, where we had 21 average days on market for July. We're now at 13 average days on market for the month of July. Looking at average days on market, again, we saw the vast majority of homes that were in those inner landlocked ring suburbs, somewhere between 6 to 9 median days, average days on market. And some of the cooler spots we saw over here in Lodo. Lodo was actually 62 average days on market. So it took a lot longer to sell those properties as you're looking at that Lodo central market. Percent of units that are under contract in 7 days or less, that hotspot still exists over here along Aurora and Denver border. Down here into the south and the west portions of town, we were looking at 65 to 70% of them under contract in 7 days or fewer. Baker was a nice little hotspot, as was Highlands at 70% of them under contract in 7 days or less, and cooler areas down here into Lone Tree and down into Elbert County, where it was only 34% of them were under contract in 7 days or less. Our average sales price came in at about $778,000, which is a decline month over month by about 3%. We've watched our average home prices fall between 5 to 7% from peak pricing. So if you've only got comps back from April, you're probably off by about 5 to 7% right now in terms of that average sold price. Year over year, we're still up 12.5% in terms of how much home prices have grown in the last 12-month periods. We're still in double-digit appreciation, and usually as we get into August and September, home prices continue to fall, so you really have to pull back on your pricing strategy, especially if the only comps that you have are back from those early spring months. Our list to close price ratio calmed way down again this month. It's down to 100.8% of our close to list price ratio. That's down from the 107.2% of our close to list price ratio for units that closed in the month of April. Likely that number is going to continue to taper off as we get into the later parts of the year. August through December, it could drop below 100%. Where we're seeing those hot spots again, that corridor of 225 over here, just where the hospital district is, Baker, getting into some of that Wheat Ridge area, south and west portions of town, and cooler spots continue to be into the Lone Tree area, a little bit of Littleton into Arvada. It cooled down below 100%, and down here into Larkspur. Lodo was the lowest with 97.9% close to list price ratio. I've had a lot of questions from people about asking, should I go ahead and overprice my home and then trickle back in the marketplace, knowing that I'm going to have to make price reductions, or should I price it right the first time? I'm still a big fan of pricing it right the first time so it sells faster and for more money. And if you price it right the first time, with 53% of properties going under contract in 7 days or less, you're likely to get 102.3% over its asking price. But sitting on the market one extra weekend, days 8 to 14, you're getting 98.1% of your close to original price ratio. In days 15 to 21, we're getting 96.3% of their close to original price ratio. We'll skip over the interest rates and affordability. We'll talk about multiple offer analysis. Multiple offers actually had a bump this last month. Looking at over asking price, it was about 34% of all the homes that closed in the month of July went for over their asking price, with 43.1% going for a full price offer and 22.8% of them selling for under asking price. Again, the vast majority, about 40 to 50%, are selling for full price offers now in this market. We had a little hot spot that popped up in that $2 to $3 million market where it was 51.7% sold for over asking price. And the amount over asking price that you're having to go is substantially cooled from where we were back earlier this year, where it wasn't uncommon to go 8 to 10% over asking price. Now for homes that are under $1 million, we're looking at 3 to 4% over asking price. So again, you're not having to go as far over asking price as what you were earlier this year. Once you go over $1 million, we're looking at about $100,000 over asking price, $100,000 to $136,000 over asking price. We had one crazy multiple offer situation that happened here over $5 million, where it went for $447,000 over asking price. So one crazy property kind of blew my trends out of the water. You're still looking at premium prices for how far over asking price you have to go on the west side of I-25 and out here into the foothills communities. Those foothills communities, if you're in a multiple offer situation, you're looking at 6 to 9% over asking price. Down here into Centennial, you're looking at about 7.8% over asking price. Wheat Ridge was 7% over asking price, and portions of Lakewood were 5% over asking price, versus some of these other areas that are in the cooler zones where we're looking at lower price properties. You're not going as far over asking price. So you're looking at about 1 to 4% over asking price in some of those communities. Price reductions are on the rise, and we'll talk about price reductions for this week coming up for units that closed in the month of July, likely under contract back in June. It was a 27% price decrease. Price reductions are likely to continue to rise through the end of the year. We ended up making 5% more price reductions than the average for what we would for July. I continue to get past articles saying that Denver is one of the ones that's leading the way for price reductions in the entire United States, and I am seeing significant price reductions across the board. Where we're seeing the most price reductions down here in Sterling Ranch at 45.7%, just south of the airport on the eastern edge of Aurora. We're looking at 45.9% making price reductions. We saw some areas that were in the Lakewood and the west Denver corridor making about 44% price reductions. Out here in Conifer, Evergreen, and Pine, we're looking at nearly 30 to 35% of them making price reductions, with fewer price reductions happening in Lakewood and down here as we get into Roxborough Park. The size of the price reduction was about 5.7%. That number is stretched out. When I look at that on a weekly basis, it's actually 6.1%. The size of the price reductions are more substantial this year by about 1.1% more off of the original asking price than what we saw in previous years in this real estate cycle. Still very few distressed transactions. Out of the 5,000 distressed transactions that we closed last month, we only had 3 total distressed transactions that closed during that month. And so the rate of distressed transactions, if a homeowner finds themselves in some level of distress, they're likely to be able to list their home for sale and go under contract very quickly and walk away with the equity that they've gained over the last few years. So the likelihood of those properties turning into short sales or into foreclosures is very unlikely at this point. I'll pause here for any quick questions and then I'll hop into the weekly numbers.
So Castle Pines, any thoughts on it?
So Castle Pines, there's still some new construction that's happening down in the Castle Pines area. It also tends to be one of the more expensive areas in Metro Denver. So we see larger price reductions that are happening at higher priced properties. And it's just cooled off a little bit since the last couple of months.
And Eddie made a comment, which I don't disagree with, and I answered him on here, but I'll let you kind of put in your 2 cents as well. He said, going off the 6 month of inventory concept of a balanced market, if we look back at what the InfoSpark said for Denver from 2010 to 2011, single family residences were around 6.7 months of inventory during the crash. So if that's the case, how is 6 months a balanced market?
So 6 months is a balanced market, and a balanced market is different than a normal or an average market. A balanced market exists when you match the rate of inflation matches the rate of appreciation. That's considered to be a balanced market. A normal or an average market in Metro Denver is closer to about 3.5 months worth of inventory when we look over the last 10 to 15 years. And so normal and balanced are very different terms when we're talking about what a balanced market is versus a normal or an average market.
That's pretty close to what I answered.
Awesome.
Yeah.
Let's hop into the weekly numbers.
Sounds good.
All right, can you see that one okay? It's August 3rd through August 9th. Cool. So looking at what happened this last week as we continue to add to our strategy sheet here, we ended up seeing that it was a slightly lighter blue week. And we had a nice little pop of activity, but overall the cooling trend continues in Metro Denver post Easter weekend. Our month supply of inventory came down to 1.2 months worth of inventory. Our average daily active count, actually for last week, we had 9.2 fewer average daily active count, but it's going to pop back up next week as I report those numbers. New listings increased by 8.1%. And pending transactions increased by 2.1%. So perhaps that little dip of interest rate ended up pushing some people into the market that were able to make purchases. I saw my order count go up last week when I saw that dip in interest rates. So people that are interest rate sensitive might be taking advantage of those lower interest rates. The odds of selling actually jumped up a little bit this last weekend, up to 54.8% odds of selling, which is up from the 51% that we saw just the week before. The odds of selling, again, is where I take into account all of the available homes for sale versus those that go under contract and or close. And I project that forward for a 4-week period of time. This number is likely to cool as we go into next week because we have more active inventory in our marketplace going into this weekend than what we did last weekend. We're still only sitting at 19.7% of the inventory required to offset demand. We'd need to be closer to about 30,000 available units for sale going into a balanced market where we'd have a 6-month supply of inventory. Again, we only had about 6,000 available homes for sale, so we're far away from a market crash just from a relationship between supply and demand perspective. Showings ended up going up this last week by about 3.1%. We saw 2.4 shows per property per week, and about 12.4 showings should yield you a contract. So again, if we're getting 2.4 shows per property per week, and it's about 12 showings to go under contract, you need to be prepping your sellers that you could be on the market for as long as 6 weeks to get enough people through these houses. Excuse me. So again, slow down the rate at which you're making price reductions, because you want to make sure that you get enough people through that house before you make a price reduction too early on in your listing cycle. Average median days on market for homes that went under contract last week was up to 16. So now we're over 2 weeks. That's 4 times higher than what it was earlier this year. And that's going to be one of those sensational numbers that the media is going to like to grab onto, where it's taking 4 times longer. But overall, 16 median days on market, or 2 weeks, is not a long time to be on the marketplace. We did see the rate of price reductions increase this week by another 1.7%. We're looking at about 46.6% of all the homes that went under contract last week had a price reduction, and the average price reduction is holding pretty constant now for about 5 weeks in a row at about a 6.1% price reduction, or about $43,000 off of their original asking price. For homes up to $500,000, our month supply of inventory also fell in this particular price segment down to 0.7 months worth of inventory. Our average daily active count went down for the last week, down by 16.4%. Pending transactions, however, also fell by about 5.6%. New listings making their way to market just this last week was up by about 14.8%. The odds of selling has started to stabilize in this market. We're now looking at about a 67.2% odds of selling during that particular week. 11.5% of balance is where we're currently sitting in this market, so we're far away from a market crash. We're looking at about 4 shows per property per week in the under $500,000 segment, and again, about 12 showings to go under contract, so you could be on the market for about 3 weeks before you go under contract in this under $500,000 market. Median days on market stretched out in this area too. We added an extra day. We're now up to 11 median days on market in this particular price segment. 36% of them made price reductions last week, with about a 6.6% price reduction. So we saw a big jump in the average price reduction for homes that were under $500,000, or about $30,000 off of their asking price. For 500 to $1 million, the cooling trend continued to settle in. We're now sitting at 1.3 months worth of inventory. It came down by about 0.2 months worth of inventory going into this last weekend. Our average daily active count dropped by 7.1%. Pending transactions actually went up by about 8.9%, which isn't surprising. When interest rates drop, this is the most interest rate sensitive portion of our market, with about 85% of them requiring financing to get into a property. So it's they're taking advantage of those lower interest rates. The odds of selling remain the same this week as it was last week, so we're looking at some stabilization there. We're now at 51.9% odds of selling. We only have 21.8% of a market in balance right now. 2 shows per property per week, and about 12 showings to go under contract in this market. So you could be on the market for as long as 6 weeks before you go under contract in this market to get enough people through that house. Median days really stretched out this week. We're up to 20 median days on market in this particular price segment. So about half the homes are under contract in about 3 weeks. The rate of price reductions doubled, or went up over half. So we're now looking at 52.8% of what went under contract last week made a price reduction, and the average price reduction was about 5.8% off of the original price. For 1 to 1.5 million, the cooling trend continues to settle in. We ended up seeing that our month supply of inventory stabilized. We're looking at about 1.8 months worth of inventory. Our average daily active count came down by 8.9%, and our pending transaction count fell by about 2.8%. The odds of selling has stabilized. We're now looking at where we were pre-pandemic levels. We're looking at about a 46.8% odds of selling at this point. We only have 19.5% of the inventory to be in balance right now. 2.1 shows per property per week, looking at the $1 to $1.5 million mark. And it's now looking like 16 showings should go under contract. And so again, you could be on the market for as long as 8 weeks in this $1 to $1.5 million market. Median days on market stretched out to 15, so about half the homes were under contract in 15 median days on market. The rate of price reductions was just below 40%, coming in at 39.1%, and the average price reduction was about 6.2%, which was a smaller price reduction, or about $84,000 off of the original asking price. Last price segment that we'll talk about. Wow, I went through this really fast this week. Holy cow. So looking at this last week, the cooling trend continues to settle in. We are now looking at 3.9 months worth of inventory, which is up from the 2.2 months worth of inventory that we had just in the last week. Our average daily active count was sitting at 203, but our pending transaction count really dipped off. It dropped by half of where we were in the previous week. So we only put 12 units under contract this last week, between $1.5 to $2 million. The odds of selling dropped down to about 30.4%, which is slightly lower than where we were pre-pandemic. And so the odds of selling continues to taper off. 32.4% of a balanced market. We should have about 620 units available for sale, whereas we only have about 203 units available for sale in this $1.5 to $2 million mark. Showings ended up increasing this last week, 1.5 shows per property per week, and it's taking about 25.2 showings to go under contract. So there were a lot of lookers out there, but not a lot of people that were biting last week. So you're looking at longer days on market as that number stretches out. For homes that went under contract last week, median days on market was 29.5 or 30. And so again, half of the homes were under contract in the first month, which is a stark comparison to where we were earlier this year, where it was 4 to 5 median days on market. 58.3% of all the homes made price reductions last week, with an average price reduction of about 7% or $137,000 off of their original asking price. Let's stop and pause for questions, and then we'll let Nicole get on her way.
Wow, move fast.
Yeah, a
no,
lot to cover. So I've had my coffee this morning.
I love that about you. No, you both of us have so much data to cover in 30 minutes. But I want to double click on this whole balanced market idea and getting caught up on whether it's inflation. We had another question asking, so does Denver have then higher inflation or higher appreciation so that our numbers don't necessarily equal? They're 3.5 versus 5 to 6. A balanced market is, and Megan jump in here as well, but a balanced market is 4 to 6. Like there's not a specific one balanced number for the entire country, but you'll hear 6 a lot. It could be 4 to 6. If you go back, I would say it's 100% it's a supply and demand issue, and a consumer will demand a product when the supplier puts the price of that product at a reasonable price given the rate of inflation. So the inflation tied to that is that price fair, and is it a market value that a buyer wants to come in and buy it? So it's a supply equals the demand. In the Denver market, we just happen to run faster. If you go back and stretch from 2011 to today, you're really going to see that it's 3 to 3.5. We hit 5.5 months of inventory at the peak, whereas the country was at 11. So it's very different. And it's not necessarily very different here than everywhere else, but every metro is going to show it a little bit differently.
Mm-hmm. Yes, and so it was actually right before we went into the recession here in Metro Denver. We had about an 8-month supply of inventory. So we were definitely oversupplied as we were headed into that last recession.
Yeah. All right. So let's jump into what's going on in the economic side of things, and we'll roll through this. And I know a couple more questions have popped up. We'll see if these are, Sunnyside area. And Megan, glad to hear you're feeling better. So there you go. But is there anything specific about the data on the Sunnyside since we've got you? And you have to unmute.
Yeah, so I can actually pull some info sparks for you for the Sunnyside area. If you'll shoot me an email, my email address is maller, ALLER at firstam.com. Once I get back to my home a little bit later this afternoon, I'll be able to pull those stats for you and share with you what's happening with Sunnyside. I need to get your street boundaries for that neighborhood though, so that I'm sure that I pull the right area for Sunnyside.
Fabulous. All right, just enough time to let me get my screen slide share going. So let's jump into what's happening with the economy and talk a little bit. So bottom line though, I have the pleasure of teaching Building an Investment Empire class. I've rearranged the deck a little bit for tonight. It's every second Thursday at 6:30, and it's back in our office. We have drinks, we have food. We've got a full room tonight. I'm super excited about that, because even in times like this, and even though I have haters talking on our TikToks and our Instagrams, when I'm talking about the opportunities that real estate gives you, there are still people that are saying, you're the reason, like the real estate is going to fall apart. It's people like you talking about the positive aspects that are going to lead to people overexposing themselves and investing in real estate. Well, it's really hard to overexpose yourself today, given the lending restrictions, plus the fact that we have an incredible amount of equity. We have higher credit scores. I'm going to show you a slide towards the end of the slide deck that you can save off that talks about how strong the buyer is today compared to the buyer in 2006. That goes to the overall, I have to have forced selling to have any kind of housing recession. And we're simply not going to have it. Megan and I continue to touch on the fact that there's no reason why I would have a short sale or foreclosure when I can simply list my home and, if not get over asking, get a fair market price for that home. So real estate isn't about the specific dollars. It's about options. And a lot of people that I sit down and have one-on-one strategies with, we look at that. What are your options later in life? And how does real estate help walk you there? That's really important for us in this industry to understand, that we're not peddling homes, right? We're building futures, we're building financial stability, and we're taking that opportunity. So let's just kind of jump in. First, 2 announcements. I got the location. Last week I didn't have it, but I got it now. It's right by the Broncos Stadium. So we will not have an Agent Ignite next week. We're just going to have our traditional Thursday market update, Megan and I, from 10 to 11. You guys, I've been doing Agent Ignite for 7 years. I love where we bring in speakers. This time we've got Patty Silverstein, who's just a wealth of data around the Denver economic market. So absolutely do not miss. We're already a quarter full, and I only announced it without even a location last week. I didn't even do a very good job of it, to be honest. And we're already a quarter way full. We will sell this thing out. There's only so many seats, and it is in the field house, so it's right near the Denver Broncos Stadium. So that's in September. Make sure that you check your calendars for that and get RSVP'd. And it will, we'll just have to close it down like we did the Mike Sherrard event. And then the next big thing is in full force. So we are designing all the speakers. We've already got several identified. It is going to be a 1-day event, not a 2-day event. We kind of talked about it back and forth, and we want to test this to go, is 1 day easier for agents to walk away from their business and work on their business instead of in it? And we're going to see if 1 day works better, and then we'll decide if we go back to 2 days or not. But I walked the Hilton last night. They're going to have 6 valets. The parking garage is right across the street. What also is right across the street is the RTD stop. So you can take the RTD in, you can carpool, or there'll be 6 valets helping. And that's going to be February 2nd. So mark that on your calendars. Tickets will be available soon. I think that one's also going to sell out, because we've got, and anybody that already bought tickets that came and joined us last year, you're going to get both days included, this day, and then we're going to do a day in the fall. So stay tuned for that. Super excited. All right, so let's jump in. Interest rates really were the story this last week. I mean, look at this. This is ridiculously insane. You can't be moving a 1/4 point to a 1/2 point on a daily basis trying to figure out how to lock somebody. And gosh darn it, if you locked them the day before, you're really pissed off because they're really pissed off. Let's just be honest. All right. So we've been watching this. We've been talking to a lot of our clients, trying to read the market, trying to help them out, doing a lot of lock-in shops, and then renegotiating their lock lower once they get under contract to make sure. But the volatility has come from the fact of there's a lot of extraneous information coming in. This is a very global economy at this point, and it kicked off a week and a half ago when the European Bank changed its bank rate. And then ever since then, we've had this trail of incredibly big news. So as that has happened, we've continued to watch this. Every time we're going low, we're letting our clients know. I mean, we're locking in the mid to high 4s right now, and we're going deep as we can. I announced that at Mike Sherrard's. I'm not going to be beat. Like, the routine will not be beat. We'll beat any other lender right now. So that's something to take to the bank and make sure that your clients are getting the best. But this is the kind of, I had, Brett Weinstein had made this mention to me Tuesday, and he said, I have never seen a spread as wide as I have right now with lenders, some quoting as high as 6, others 5, 5.5, and some in the 4s. And this is the reason why, because certainly a lot of it has to do with when you ask the question, what is my interest rate? Waiting until the next day could change the answer. So on news, on Friday, we had 2 reports that came out, and those 2 reports are the jobs report and the unemployment report. And so we have finally hit the number. A lot of people thought it wouldn't be until September when we regained all the jobs lost. I mean, look at this. This is the worst job loss recession. These are all the recessions, and how many jobs we lost and how quickly it took us to get back. So it is official. We've recovered all the jobs that we lost during the pandemic, and it took us 29 months to do it. So that came out on Friday when we hit the 528,000 jobs number. Now, it's really important to understand that there are 2 reports that come out at the same time, always the first Friday of the month. So the first Friday of the month is a look back to the previous month's job numbers. And this is taken in the middle of the previous month. So you're 3 weeks like kind of historic at that point. It's not that week data. It's the middle of the previous month. But this is a business survey. So this is a survey is what businesses have opened and what businesses have closed. It's called a birth and a death rate. And then how many employees that business typically hires or has. And so then they determine how many jobs have been created or lost. And so this is more of an estimated survey, but it came out with a really, really, really strong number. And of course, this moved the markets. We were not expecting this. The big number on here as we watch continued forward, and I'm going to talk about inflation in a minute, is this average hourly earnings at 5.2%. That's big. I mean, that's really big. We talk about the fact that Denver's had some really strong earnings, but to have a nationwide number with the number that we usually see in Denver is really high, right? Because you got to think about that. That includes Mississippi and Kentucky and Oklahoma. And so you're going to have different price points as far as wages go. So this includes the entire nation. That's a big number. And that's going to continue to push inflation higher. Because although we saw a drop, which I'll show you in a minute, we're nowhere near the 2% target rate that the Fed has. So that came out. And then we also saw a second survey difference. So the business survey is a jobs report. Then we see the unemployment. The unemployment dropped from 3.6 to 3.5. And I really want to take a minute to go every time right before a recession, the unemployment drops. So we're seeing that right now, that it's dropping to a 50-year low. The idea being that we're not in a recession yet, that when jobs loss, yes, we've had 2 consecutive quarters of GDP decline, but really we're continuing to see jobs increasing. We're continuing to see the strength of consumer spending. Those things are hard to deny when you're trying to measure a recession. And why does it matter? A lot of things we're just creating. We're creating a recession-like environment, regardless of whether or not the numbers tell us it's a recession, because we create the reality that we believe. But the unemployment number did go down from 3.6 to 3.5. Now, a lot of that also had to do with the people leaving the workforce. So the job creations number in the household survey is where they actually call. So they literally call households to get, are you working or not working? What they don't ask is like, are you working multiple jobs? So there's a lot of kind of, I don't want to say still estimation in this. This isn't an exact science. It's more of an art form, but they're calling. And then you get people to say, yes, I'm working, but I'm only working 5 hours a week. Or yes, I'm working, but I'm working at a job that I wasn't paid to do. I'm working at a sub job, whatever that is. But they saw 179 jobs, which that's a significant difference in the business jobs. If you remember last month, the business report came out 300,000 positive. The household survey came out 300 jobs negative. So they can be different. And a lot of that difference has to do with the part-time jobs. But that did drop the unemployment. And really the unemployment number is just a simple division. We've got 5.7 people unemployed. We've got 164 million in the workforce. That gets us to a 3.5. We saw the labor participation rate drop. We're seeing more people hired to do less work because we're seeing a reduction in GDP. That's how you measure less work. So I'm seeing more jobs, less work, which equals less productivity, which typically is an inflationary measure. Our bonds did not like this, and our rates jumped up on Friday because of this report. And you're like, but the rate should get better is good news, but it's inflationary because we're continuing to see jobs, yet we're seeing GDP decline. So you put those 2 reports together and you get a lack of productivity. Initial unemployment jobless claims just came out this morning, and it's continuing to tick up, which is really that indicator that, yes, companies are still laying off. Yes, we're still seeing new jobs. I mean, it's really hard to reconcile. It's exactly the same as some of the data points that we have in real estate right now. It's kind of hard to reconcile. Is this a weakening economy or is this still a strong economy? We're seeing more people that are getting laid off. We're seeing more people who are entering into initial jobless claims, yet we're still seeing job numbers created, a high number, over 500,000 jobs created. But this is the number to watch, because as we see more people being laid off, we will see that unemployment number start to tick back up again. And that will start the beginning of the recession. Fannie Mae came out with a consumer sentiment index report this week. It was the housing sentiment fell to the lowest level since 2011. And they came out saying that 17 of the consumers, buyers, believe that it's a good time to buy. 67% of the sellers think it's a good time to sell. That number is actually down from 76. So it dropped from 76% of sellers because they were having a heyday. I'm shocked it wasn't 100%, honestly, over the first 4 or 5 months of the year. But it was 76, dropped to 67. So both buyers and sellers don't think it's a good time to do either. Like everybody just wants to hang on. I got a really low interest rate. I'm not going to put my house on the market and I'm not going to go out shopping. Maybe that's what you're seeing, right? Because that's what the numbers are saying as far as the sentiment goes. So the Doug Duncan, the Fannie Mae's senior vice president and chief economist, says some homeowners may opt to list their home sooner, which we saw that. Some of those fall listings got pulled in. Others are going to wait until spring, waiting for the buyer's market to pick back up again, while some potential home buyers are choosing to postpone their home purchase. I'm talking to a lot of buyers who are waiting to see what happens with the economy. Now, I could preach all day long and go way longer than my half an hour talking about why waiting is going to cost you a crazy amount of opportunity and possibly money. So we're going to continue to see appreciation. It's just going to happen at a much slower rate. Yes, you will be able to, and right now you're going to be able to get that home at market or even under. I'm worried about what happens next spring. And I'm going to show you some charts as to why I'm worried about next spring and why this fall might be the reason or the timing that you want to get your buyers re-engaged. So the median home prices, I was putting this chart together. So they talked about right in here. Okay, so housing sentiment falls to the lowest level since 2011. So like 2011 was the worst time to buy. So I went ahead and I looked at that. I go, okay, so what's happened with prices since 2011? So we dipped a little bit in 2011. So that was fair. So sentiment was probably going down right about then because interest rates actually spiked up about 0.5 point right about then. But then what happened? So if 2011 was the worst time to buy, and this is the worst time to buy, where are home values going from here? Because we know ultimately long-term home values continue to go up. So that just showing the impact of the lower interest rates. You see some small differences, but overall those home prices are continuing to go up. Small business optimism also came out this week and it just tipped up 0.4 points. So not very much. They're still calling out that inflation is the biggest deal, but they're getting slightly more optimistic about the opportunities in the future. They still can't find enough workers. They're still paying too much for their workers. They're still dealing with inflation and supply chain issues. Yet, I don't know, I'm feeling a little better, like something's going to happen, right? Or maybe I'm dealing with the worst of this. So as they're trying to work through this, to see that it's just the small businesses are still going out, which is a good thing, because when they're optimistic, they're spending money on a business level and a personal level and buying homes. Those people who have money are still buying homes. CPI dropped. That number came out this week along with PPI came out this morning. So the consumer price index came out dropping from 9.1 to 8.5. But interestingly enough, the core stayed at 5.9. So that excludes food and energy. So what we saw was the drop that was all inclusive, which really is due to the energy. And we saw that both in the CPI and in the PPI. So this number dropped mostly because of energy. And if I actually break out the chart for you, you can see that energy dropped 7.7 for an overall unadjusted 44% increase from last year. But month over month, it dropped 7.7. That was eaten up by a 1.1% increase in food and a 0.5% increase in rent and housing. And we know that rent and housing has gone up a lot more than 5.7% year over year. Those shelter costs are still low. It takes 6 months for them to be baked in, which still 2021 should be baked in by now, but they're always going to be slightly adjusted because this is an owner's anticipation of what would I charge for rent? Would I rent out my home? Which is a little bit weird because unless I'm a landlord, I'm not really thinking like that. And I'm probably going to way undervalue that number. That shelter cost, though, does make up 1/3 of the CPI, and it is holding it up along with food. So I read into that a little bit more, and it's butter, eggs, and coffee. And that just kind of broke my heart because that's pretty much the staple of my diet, especially the coffee part. So the PPI also came out and it dropped from 11.3% to 9.8%. So this is just showing the index number, not the percentages, but it dropped right there. I mean, we're at an all-time high and it just dropped slightly. So that PPI number is starting to roll back. These are good, right? I mean, overall, this is good for the economy to start seeing this pullback, but this was also due to gasoline. Gasoline prices were down inside the PPI 17%. That attributed to 80% of that headline number coming down. If you exclude it, the PPI actually increased 0.2% if I take out the food and energy and I just get down to core. So really the bottom line is, although the news cycles are picking up that inflation might have topped out and is easing, we still have this core inflation that is hanging on. It didn't move for the CPI, and it actually went up 0.2% for the PPI, which is the wholesale number, right? The producer's price index, which is kind of everything. It's mostly trucking, right? It's the supply chain, getting it to the stores and getting it to the consumer. So we saw that in all of that, we saw very little movement in our 10-year treasury, but we are starting to see it narrow down. So I took these blue arrows right here. And before this last week and a half, we were really settled in on 3% for the 10-year treasury. So that's when we were seeing about a 5.5%. And we even topped out up here to where we were seeing 6.25% interest rate. So these are not the interest rates, these are 10-year treasury yields, but the thing that drives the long-term mortgage bonds. Now we're starting to see it's narrowing in, and it's narrowing in closer to 2.8. And that's actually what it started out of this morning. And now it's like 2.84. So it's moving up just slightly based on the PPI numbers and the jobless claims, but it's very small movements. Rates are kind of settling in for the moment. It's going to take something big, and I don't know what that is, to kind of make us jump out of this pattern, whether it's up or down. So to say interest rates are going to continue to stay where they are right now is a little false hope. I do think something's going to happen, but interestingly enough, they haven't moved that much, although we saw that first chart where the interest rates were doing this. It's still within a very narrow range, and it's volatile, yet it's not striking out. It's going to take us a lot to get back to 6. So somebody that's talking about 7 or 8 requires a really strong economy to get up there. In fact, I think that once we start nailing down this inflation, and as we get towards the end of this year and the beginning of next year, we might even see interest rates go back to, say, 4.125, and that could create a really healthy space for both the builders and the existing home buyers. So we'll see where that goes. So, but what can make this break out, right? So we still have commodity wars going on. We still have Russia-Ukraine war that's happening. And now we have this new Chinese, or the China-Taiwan threat, of course, because the White House, we went over to visit. So why not just stir something up right about now? Because that seems like the perfect timing. So we have all these things happening that could create more of this global impact on our local economy, which is going to impact our interest rates. Because you're like, why do I care about this stuff? I mean, we all care about this stuff. How am I impacted by this stuff? Because it's impacting my affordability and my interest rates on a daily basis as we're hearing news about what's happening globally. So on the real estate side, nationwide, Megan dives knee deep into Denver. And so you guys are feeling everything she's saying. I just wanted to reiterate, we're not alone. Like, the entire country is going through this kind of inventory issue, and we're struggling. So we've been all seeing this increase in inventory rapidly as interest rates went up. But that is slowing. Over the last 4 weeks, nationwide, we've seen inventory slowing. So it's not like somebody can just pick up and move here and they're just going to get a great deal somewhere else. They're going to move to a lower priced economy somewhere else. That's absolutely true. But it's not like they're going to get deals, because inventory is stretched nationwide. And if this continues to slow down, if it levels out, as it usually does seasonally, and we hit October and we haven't gained a pickup in new listings, nor a slowdown in demand, because our demand is kind of just flat right now, and I'm going to show you that chart in just a second, then we're going to land the end of this year with less inventory going into the spring selling season. And if that happens, and what I just said happens, where we get a 4.125 interest rate, we're going to have a swarm of new demand on limited supply, continuing to increase those prices and pushing out first-time home buyers again. So getting them in this fall doesn't hurt them. right? I mean, because you could say, well, what if prices go lower? Or what if that doesn't happen? Or what if interest rates don't drop? And what if? Well, if they get into a home right now, they're buying their own home. They've got principal reduction on a monthly basis, not supporting their landlord's retirement, but supporting their own. And they have the opportunity for continued appreciation. CoreLogic put out that report that says we were 18.5% looking backwards, but they expect 4.3% looking forwards. If I just even have a 4.3% rate of appreciation and principal reduction, given a 4.99% interest rate, I kind of flooded social this week with Instagram and TikTok talking about the fact that on a $615,000 home with 5% down, that could yield me 114% return on my initial investment. As a home buyer, I'm not even talking about as an investor. As a home buyer, where most of my wealth is in my singular home, my singular roof over my head, that gives me stability. I'm getting a better rate of return on my own home than I can in the stock market or in cryptocurrency. And I'm no longer supporting my landlord's ability to build wealth. So those are the conversations that I understand that it's a little bit risky, but make sure you buy within your limits. Make sure that you have reserves and money left over. Make sure that you've got cushion in your budget. Like, don't overexpose yourself walking into what we know is a recession, but create an environment where you're not trapped in a rental, where your landlord can raise rents and you've got a stability of monthly payment, and you're building wealth at the same time as we work through this recession. Because this recession very well could be very short and very mild, but it will shift up things. So you've got to protect yourself, but going all to cash and selling something just to rent or not buying just to rent isn't the answer if you have the ability to purchase. So nationwide, from NAR, just showing how drastically low, even if we saw this massive uptick, we're still under 1.4 million homes, and that includes pendings. I just want to, like, if you look historically, we've been dropping inventory since 2014. This isn't just because of the pandemic. I believe that we have, based on the fact that the biggest generations are in front of us, the younger millennials, of course, the older millennials have already bought their first, they're working on their second, and then the Gen Z behind them, we still have demographics that are very strong for home buying. Yes, I always talk about the fact that the oldest age group is 30 and the average home buyer, first-time home buyer is 33 per Freddie Mac, but we still have all of those regardless of the average first-time home buyer when they're getting in. And the Gen Z, they're my kids, right? They want to buy an investment. They're just not buying one like the baby boomers did. They're buying 2 or 3 or 4. And you can sit here and complain that they're stealing from the first-time homebuyers, but they're building wealth in the way that we know does on a regular basis, because real estate always goes up. But you have to be secure to weather the down markets. So if I see this, where I see inventory continuing to go down, it has been going down since 2014, what's it going to take to get inventory back to where we have enough, where we don't see appreciation continue to be up? Because if I don't have forced selling and if I still don't have enough inventory, I'm still going to see pressure, upward pressure on home prices. So an argument that we might see a bubble or a bust or a drop in prices nationwide or overall, locally, I know real estate's hyper local, and I know some blocks and some areas should never have experienced the gain that they did over the last 2 years, and they will probably have to adjust. But overall, we're going to continue to have pressure on inventory. It's not going to happen. It's not going to fix itself overnight. You know, and at realtor.com nationwide, we continue to see that inventory is going up, new listings is going down, yet the median price continues to go up. Here in the Denver market, in the last DMAR report, we saw an 11% median price growth with an 81% increase in inventory and a drop of new listings. So that those kind of numbers continue to kind of mind blow. It's the same kind of issue that I'm having reconciling this increase in initial jobless claims, along with the unemployment number continues to go down. Of course, I know the participation rate, but we're seeing over 500,000 new jobs, yet we're seeing an increase in initial jobless claims. We're continuing to see prices go up year over year, yet we're seeing that we've got more inventory available for buyers, and we're seeing buyer demand is kind of just settled. It was up 1% last week. It's down 1% this week. So it's kind of settled right into this rhythm. Like, this is our core buyer demand, right? Because like we had this crazy spike. We didn't know what to do with these higher interest rates. People stopped being a want to buyer and now they're a must-be buyer, right? So it's not because I just want to get a new home or a second home, or maybe because I want to have more space or an office in my home, or maybe I just want a bigger backyard for my kids. So I'm no longer a want to buyer, I'm a have to buyer, but we're still going to have to buyers because we're still going to have deaths and births and marriages and all the things and job transfers that life brings. That life is happening outside of our industry. I have a really hard time putting my arms around that because I'm pretty sure it's all inside our circle, but life is happening and they don't care that the Fed is raising or dropping the Fed rate. And they don't care about our issues with inventory until it affects them when they're shopping. But interestingly enough, this is giving buyers calm. One of my teammates are out looking for a home right now. And she's, I've got another teammate that just bought in the middle of the crazy. And she's like, oh, we got to go look. And my other teammate who's now out looking is like, I got time. I'll go look at it this weekend. Oh, I'm not worried about it. I mean, it's that has changed dramatically, giving buyers the opportunity to not rush to purchase something that they're going to regret. Yet we continue to have a strong buyer pool, right? So continue to watch this. I mean, we know that we have an average 30% loan to value compared to 2007, it was 41. We have an average credit score of 715 or 714 compared to the mid to high sixes in 2007. We have a stronger buyer pool. We have more underwriting guidelines around buyers today. And we have all of the homes that are owned free and clear and all the homes that are locked in under 4%. We have a strong buyer pool. If I look at this, yes, the units are down because we know that. But if I look at this, the blue is over 760. If I go down to here, it's everybody's over 660. That wasn't the case in 2007. Here's the 660 mark. We only had a few buyers over 660. Everybody else was below that. Now, oh, I'm sorry, the 660 mark is the light gray here. So still half of the buyers had under 660, half of the buyers had over 660 in 2007. Today, I don't know what that number is, 95% of the buyers have an over 660 today. The strength of the buyer is going to continue to support the strength of the housing market. And anybody who's out there thinking that we're going to see this housing recession, we're seeing a slowdown. We're seeing sellers are having to become more realistic with what they list their homes for. We're seeing buyers who are able to get in with down payment assistance, sometimes 2 down payment assistance programs. That's crazy, and we're doing it. Or renovation loans, and they're able to build the home they want. And I'm going to land with this. So I get, this is July, so it's just a little bit dated, it's 10 days, but looking at how many appraisals are coming in low because of this new real estate market, those buyers who still have to bid over asking, nobody's running into appraisal issues. So Colorado wide in July, 2%. So far in August, 3% of the homes came in below. Here in Denver, we're working on our 3rd month of none. No appraisals for FLS, the appraisal management company that Fairway uses, no appraisals coming in under. That is stability. That is security. Well, with that, Miss Megan knocked it out of the park.
We got through it all. We have a couple of questions that popped up. And so how much of an interest rate is a good time to refi?
So that's a great, I remember with my first house, I chased that interest rate all the way down. I think I refinanced like 7 times. So if you can get, it depends, is the answer. A lot of people will just throw out a number and say, well, it's got to be down a point or it's got to be down a half a point. I would say, does it materially impact your budget? A lot of it has to do with your loan amount. You know, a half a point decrease on a $500,000 loan versus a $200,000 loan is drastically different. So it has to materially impact your budget. Or 2, can you take advantage of cash out, optimize your primary home is probably your worst investment. How can you take that and then continue to build wealth? That's what I'd be looking at. Can I pull cash out and does it materially affect my budget?
And then we have a question on migration. I've seen that Denver is now a top 10 move out market, which reverses the trend of always net gain in population for many readers' comments. And so are you seeing that trend?
I'm seeing that trend when it comes to moving companies. I mean, the Census Bureau is not doing it yet. So I'm finding different surveys and it's mostly moving companies that are saying that. I've seen a report on Redfin saying that. I don't know. I'm still talking to buyers that are moving in from out of state constantly. I still drive on I-25. And I guess at some point, yes, Denver will become unaffordable. yes, I said that right. Denver will become unaffordable for probably an average worker, but we will continue to see the people come in from the Chicagos, from the Bostons, from the Californias. And we're still in the top 10 of everything else, places to retire, places to raise kids, places to go to school. I just think maybe we need to lose a few people that we gained in the last couple of years. They're taking their chips off the table and going somewhere cheaper.
Definitely. Well, cool. That's everything. We've got all of the questions answered. There was nothing on social media. As a reminder, we'll go ahead and send out an update with the link in the video and all of the reports for you guys to be able to download and use to better advise your buyers and sellers. And we certainly hope that if we're able to help you better advise your buyers and sellers, that they'll land at Fairway Mortgage and Nicole Ruth's team, or at First American Title with Megan Aller. We're doing this to help you better advise your clients, and we hope that if we're able to do that, that we end up getting business out of this. So please keep us in mind for your next transaction, and we will be back at it next week. We'll see you guys later. Have a good one.
Bye-bye.